Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thanks for watching this weekly stock market update for the week of Friday, May 3rd, 2019. Before I jump into the charts and commentary, I'd like to begin with my quote of the week. And this week's quote is from Mia Hamm. She once said, "Celebrate what you have accomplished, but raise the bar a little higher each time you succeed." Those are some very wise words from Mia Hamm. Well, I want to begin by saying that if you have a 401k plan, an IRA, or some other portfolio of investments and you have not already talked to me or are not already working with me, I strongly encourage you to please contact me and talk to me about this current stock market, because even the short-term CNN Fear and Greed Index is in the greed section right now. And I've been at this financial advisor career now for over 19 years, and I have never seen a more frothy, more irrational, more overvalued stock market in my entire 19-year career. So if you have not spoken with me already, please give me a call, because I think we are getting very close to something happening, and I'll talk to you about that in the very near future right here in the charts coming up. Most specifically, I want to talk to you about the volatility index, and if the volatility index goes higher, well, that means that typically stocks go lower. And because we are sitting up here at or near or exceeding all-time highs in several indexes, well, I think lower is probably just about due. That is the result that I see in the very near future for stock investors. So before I jump into that, though, I'd like to say my contact information is right here on this social media page, in the summary of the YouTube channel, or you can just go to christensenwealth.com, and the other information is at the end of this video. So please go to those contact pages and then just either send me an email, message me, or just pick up the phone and call me like we once used to do. So anyway, let's go ahead and talk about some of the economic information that I feel is relevant. The S&P 500 and NASDAQ hit record highs last week on Tuesday. Stocks are doing well since Christmas because the Federal Reserve essentially caved in after the 20% stock market crash ending at Christmas, and the Federal Reserve has put interest rate increases on hold, and the consensus out there right now is that the Fed is probably not going to raise rates any further. Most likely the next move will be lower, but when is the question. So stocks are doing well, but we are on very, very thin trading volume as we speak for the S&P 500. Globally, the economic slowdown is declining in many of the other areas, such as Japanese industrial production. That has been going negative the past 3 months. Home sales, for those people living in fancy New York City who love to vacation in the Hamptons, well, home sales in the Hamptons have been slowing to the lowest level in 7 years. Global trade volumes are plummeting. Take a look at this chart right here of global trade volumes. You can see that it is definitely in a significant decline. Global electronics output is quickly declining, which you'll see in this chart. That is pretty obvious from the appearance of the declining trend in this one. Now, Q1 GDP, gross domestic product, announced last week for the U.S., indicates a slowdown right hiding in plain sight. The announced GDP was 3.2%, but what we did experience in last week's GDP is the government, in order to boost that GDP, dramatically lowered their estimate for inflation. So most of the inflation data was coming in at double what they said in the GDP announcement last week. If the announced inflation rates, like the consumer price index and stuff, were used instead of the the number they used in the GDP, well, we'd have a gross GDP growth rate of less than 2%, which is not good at all. I mean, it's very slow. And consumer spending rose only 1.2% in the first quarter after healthy 2.5% growth in the previous quarter. So consumer spending is down 50% in just the last 3 months. And the last one here is spending on durable goods plunged 5.3% in the last quarter, the worst print since 2009. So anyway, we got all kinds of economic data coming in cold, and the stock market is just continuing to hide up here and hang up here at all-time highs or near all-time highs, and I think that it is just about ready to capitulate. So in closing on this portion of part 1 of this week's weekly stock market update, I think the next leg for the stock market is to the downside. And as I always like to say, getting back to even is not an investment strategy, and the best way to make money is to not lose it in the first place. So my advice is to, first of all, call me if you have stocks or stock mutual funds in your 401ks, IRAs, and other accounts, and talk to me about how you can best, or I should say, how can you manage risk if the next leg for the stock market is lower. There are alternatives. I mean, bonds are an alternative, cash is an alternative, and I'd be happy to talk to you about that. So I'll go ahead and wrap up this part 1 with that information. Economic information economic numbers are declining in many categories, many of the most relevant categories, and the stock market is choosing to ignore them for the time being. And in the next part 2 of the video, where we go into charts, again, volatility looks like it's about ready to explode to the upside, which means that will be volatility in the stock market as well, most likely to the downside. All right, thanks for watching. Tune in to part 2, and I'll go into all my charts and show you what I see and why I think that the market's headed lower. Thanks. Have a great day. Bye-bye.